All views, opinions, and comments expressed herein are solely those of the speakers and do not necessarily reflect the views or opinions of StoneX Group Incorporated and or its subsidiaries. This content does not constitute an offer or solicitation to open a trading account, to trade in any specific product, or to engage with any services provided by StoneX Group Incorporated or its subsidiaries. This content is not intended for residents of any particular country or jurisdictions where such content is prohibited.
Welcome to the Trading Global Macro podcast from StoneX, where we unpack the complex forces driving global financial markets. I'm John Kicklighter, Global Head of Content at StoneX.
And I'm Matt Weller, Global Head of Market Research for StoneX's self-directed brands. Each week in this podcast, we explore the macroeconomic trends and geopolitical events shaping Forex, equities, commodities, interest rates, and more. We're back after a one-week hiatus. Appreciate the patience on the part of the audience. John, what is our topic today?
I think our topic today, again, trying to be topical, is looking at when economies and markets become pariahs. Essentially, the world tries to align against a country or an economy because of perceived poor trade practices or aggressive activities. Obviously, this is happening now with the United States, where a lot of countries are crying foul because of the demands to change trade relations and negotiations, whether it be NAFTA, which is the USMCA, or NATO after the pressure on Greenland. And what happens? What is likely to happen with the United States? And I think that's where we want to eventually get us. So that's going to be our conversation today, and that is our motivation. Perhaps a little bit more about why, some of the structures or the developments that can happen, and put economies at odds where you actually have groups of economies aligning against an individual. And I think there's some situations in which you can have bad actors, very aggressive. I think perhaps the situation where we have Russia, where it invaded Ukraine a few years back, and much of the Western world aligned against Russia and its actions, because causing that level of uncertainty for the safety of the world, and obviously threatening the structures of conglomerate support. Something like a NATO, and putting us at a risk of a polar world war potential. Obviously, hopefully still low risk, but still that pressure is escalated. And those are types of situations where we can see these kind of developments. And we also have a lot of emerging market economies that find themselves the at the sharp point of pressure. What kind of emerging market economies do you recall readily from the past, Matt?
Yeah, for me, it kind of comes down to situations where there's chaos and uncertainty around policy. There's large debt and deficits, so there's a concern about getting paid back. In some cases, politicization of institutions, things like these pillars of developed economies. When those start to break down, or there's at least a narrative that they're not as reliable, then that's when you can see some of these countries be put on the out. So we'll kind of go through several examples. I don't think any of them are quite putting the pin on the current situation with the U.S. right now, but one that comes to mind perhaps could be a country like Italy, both pre-Euro and after the Euro. The country of Italy sort of investors demanded an extra risk premium because there was uncertainty about the productivity of that nation, of high inflation, of occasionally misleading debt and deficit levels. And in those types of situations, that's when you can see higher bond yields from a market perspective. You can see a weakening currency back when when Italy had its own currency before the euro. And that's sort of the financial markets putting pressure on the country in place of some of the normal expected government institutions. So I think those could be, maybe there's a couple threads we can pull out there that are relevant, but again, it's a smaller country. It doesn't have the same type of dynamic economy, for example, as we have here in the U.S. But that is one small example that comes to mind that may be impacting, that might be relevant for our conversation here today. Do you have anything to add there? Any other countries to offer to your mind?
Yeah, I mean, you have the debt considerations, which is, I think, a really obvious one for Argentina, the or Venezuela. Obviously, that is one that has been very much in the backdrop of the mind. And you can see here from the dollar Bolivar exchange rate as an example of what kind of results can happen financially. Massive devaluation of the currency. The same is true of the Argentine peso. Even countries that are a little less in terms of size or more sizable. You can get into countries like Turkey, where financial stability is more of the consideration in the debt considerations, and getting those repayments. And Turkey is one of the largest emerging market countries that you have, so it can scale up. I think one that to introduce us to this concept that we talked about before we started, that I want to touch upon, I think, because it's a starting point where I think it can be obvious to everyone, because it is more of a pariah, and that's, and I don't even know why I'm showing the exchange rate because it's kind of just flat. But it's the Iranian rial. So Iran is very notably a pariah on the global stage, because of its militaristic approach and because of its threats that it makes constantly within the region. Lots of long-standing issues there. Obviously, a regime change a couple decades ago that was instigated by the United States, and subsequently leading to problems there because of the political structures and the disagreement that they have with much of the world, although they have their trade relations. But very clearly, their status to, let's say, the Western world, where a lot of the money is, creates this problem where they have a very difficult time facilitating growth and consistent expansion and being part of the global um, the global symbiosis. Which, if you're not able to interact, you're a pariah to the rest of the world, it can dramatically impact your economy and subsequently throttle you from any kind of economic potential, because you either need to have all the sources of supply and demand native to your country, including foodstuffs and other materials, or you have to trade for it. And Iran is not a country that has all of its necessities. It has to trade, and it has a few countries for which it does trade with, but most of the world has cut them off, and sanctions that are coming from other countries, like including the United States, that are stretched to those countries that are trying to trade, materially impact their ability to facilitate growth. So a very obvious one with extreme impact, and is still remarkably a very large economy, Iran. But it is incredibly hampered because of that pariah status. But that's probably one of the most recognizable. What's perhaps a little less extreme on this scale and getting us closer and closer to the situation for the United States for you, Matt?
Yeah, I think your examples are perhaps most illustrative of the high level question. I looked up pariah while you were speaking there, and the best definition is an outcast. And I think that's very relevant for some of these emerging countries where essentially they can be blocked out of the Western, the developed world financial system, and that obviously has big implications for their economies. Where some of the examples I pulled in earlier, you know, Italy and Greece, those types of countries, I would say are still participating. There's just that modest credibility premium. Another example that comes to mind might be the UK. Back in the 1970s, the UK obviously developed economy, one of the larger ones in the world, but it's still I would say didn't become a pariah or an outcast per se, but maybe took a couple of steps down that path that stemmed from things like large fiscal deficits, declining industrial competitiveness, wage inflation, and then the ultimate market implication was a persistent weakness in the UK currency, the British sterling. So those types of examples, I think, might be more that mid ground of where I wouldn't say they became an outcast, obviously, but there was some uncertainty there, and some of the premiums reserved for the best credits, the most stable, credible countries on the planet it started to tip out of that range there. And perhaps that's something that you could pull more into the middle of that range as an example of. It's hard to imagine something like that happening to the U.S. right now, but I think it's probably easier to imagine that at least before we would ever get to any sort of Argentina situation. And then I think you also had a more modern example that you might want to pull into, John.
Yeah. So I was trying to get us to scale. So if we want to relate it to what could happen to the United States, you have to consider how large the United States is economically, and what better country to compare to than the second largest economy. I mean, it's the most correlated, and that's China. So China, in terms of economic size, is massive. But this is also, for those that are watching, this is the chart of the US dollar Chinese yuan exchange rate, which you don't expect that kind of movement from one of the largest players in the system. That's because back in the 70s and 80s, China wasn't in the top five. It's leapfrogged to that position, and it still is considered an emerging market. That's remarkable. It's the second largest economy in the world, yet it still is classified as an emerging market, much to their preference. And that's because it allows them to have to pursue certain policies that maintain a what is considered an advantage that other developed major economies do not pursue because it's considered to be an unfair trade practice. But China has gotten itself to be the second largest economy in the world in terms of GDP, and it continues to act as if it's not. So we have. I know that a lot of the headlines today are about U.S. and its trade practices, and it's pushing back against its trade partners, and how that's raising concerns. But China and its trade practices has been an ongoing consideration. I mean, on and off in the headlines for the past couple of decades. Accusations by governments that they are kind of pursuing a strategy that is giving them a completely unfair advantage, and they continue to operate and still trade despite those accusations. And they managed to use it and leverage it to a point where now they are the second largest in the world. So this, I think, gets us to a little bit more of what the situation is with the United States, because the U.S. is the largest economy, China is the second largest economy. There's a much stronger corollary there, and an accusation. And there have been efforts in the past by the United States and other countries to essentially do what they can to create this pariah status for China, but they can't because it is one of the largest economies in the world. It uses that size to lend significant sums to struggling countries around the world. And then the purchase of Chinese debt puts it more at a greater exposure on the global scene. We also have, if we look at the most recent triennial report, that's from the Bank for International Settlements. It's a measurement every 3 years to see what countries' currencies are being used most heavily, and the level of activity across these financial bounds. Otherwise, it's very difficult to measure this. There is no common standard measurement like you get on exchanges. But we've had a massive jump. I mean, I've been monitoring this for the past couple of decades as I've been an analyst. I'm sure you have too, Matt. But the Chinese yuan was almost never on the spectrum for the top 10. And as of most lately, it's just behind the British pound and ahead of the Swiss franc, which for me, you asked me that 10 years ago, I would have thought that that was crazy talk. But here it is. And the global use of the Chinese yuan has climbed despite the ongoing accusations that they're still pursuing unfair trade practices. So we get to size and scale where making a country or an economy, or even the government that is running these economies, a pariah just simply doesn't work. I'm not saying that you can't pursue it, but it does become a lot more difficult to exact that kind of pressure on a country. Now, I will say that in the past, countries and collectives have essentially tried to distance themselves and de-emphasize their connection to the United States. If you recall, Matt, they were trying to pursue IMF-based SDRs as an alternative to the U.S. dollar. That went nowhere because you couldn't really replicate or replace the U.S. dollar, U.S. Treasuries as those safe haven assets, those benchmarks for that are fungible and immediately alternative to whatever currency you have, whatever, gold or other alternative fiat. And you can still see, and you see related to the Chinese yuan, which is 8.5% of use in 2025 of currencies. The United States' dollar is 89% of global currency use. So it becomes a very different measure. But I would say that the Sell America, which I have as in this Google Trends, the pressure is there, the concern is there, the anger is there as the Trump administration pursues a renewal of the trade war in its second term, and they have situations like Greenland starting to come to pass. And threats against, I guess Canada was most recent, 100% tariff that they threatened if Canada pursued a direct trade relation with China. So the pressure is there. But what do you think, Matt? Like, can there be a effective pressure put on the United States so that they back off of those policy approaches to reestablish a stronger and stronger footing in the global hierarchy?
I do. I and perhaps you as well, John, believe strongly in the power of markets, and I think we can see, for example, with our current president, he gave this highly politicized speech to at the Davos World Economic Forum summit, and among other things, talked about how he wouldn't use force in Greenland. But my other main takeaway from that was that he specifically highlighted for several minutes how many new highs the stock market had made, and how he wanted to get interest rates down. And I think, sort of in the absence of legal or political checks on some of these decisions and policies, the markets can step in there, and we can see, for example, if stock markets start falling, if interest rates start spiking, that's the type of thing that can bring certain policymakers that are watching those things back into line. So I think that might ultimately be what we could see if there is continued growing concern. Of course, for now, we haven't seen that. Yes, the dollar is weak if you're down like digging through the trees, but if you take the broader look of the forest, the U.S. dollar index is essentially flat over the last 10 years. It's gone down lower. It's been up higher. It's kind of in the middle of that range. So I don't think we're necessarily seeing that come to the fore right now, but it is something that to be aware of. And at the end of the day, I believe financial markets are very powerful. People can vote with their dollars, and at the margin, at least over the last few weeks and months, we are seeing some sell America and perhaps some diversification away from the U.S. But to your earlier point, it's the world's reserve currency. It's involved in 90% of foreign exchange transactions. It's not something that we're suddenly going to see change like a light switch. I think I've used this example before, but it might be a situation where there's a bit of a dimmer switch where at the margin, different countries could settle an agreement in a currency other than the US dollar, or perhaps smaller trade relationships based around different regions might crop up just to sort of diversify. And we're seeing that, for example, also with central bank balance sheets, that they're perhaps less heavily exposed to the US dollar than they've been in the past. So I think a lot of this, thankfully, is a theoretical discussion at this point. But if we were starting to head down that path, this is sort of how it would start, with weakness in the US dollar, with rising yields, with a bunch of geopolitical hullabaloo and concern. But again, I want to emphasize that we're maybe, in mile one of a 26-mile marathon on the path to the U.S. becoming a financial market pariah. Do you disagree with that assumption, John?
No, and I think you're right, and I caught that little Freudian slip. They can vote with their dollars because they are heavily
There you
exposed
go.
to dollars. I mean, there's not a lot that you can do necessarily because you need to coordinate to approximate the size of the United States, you need to have a collective GDP that can be competitive. And that would mean, like, as Canada tried to potentially pursue a relationship, a direct relationship, and large relationship with China, that could approximate a large economy. But at what cost? 100% tariff from the United States, which is a much more established and large trade partner, where their proximity and their infrastructure really has strong trade lines and economic ties. That would be massive. And can China compensate for that? You need to have an ability to essentially offset the kind of pressure you're going to get for setting a country as a pariah. And there, unfortunately, unfortunately, across the world, a lot of countries are not willing to do the necessary alignment so that they can benefit each other collectively. And this happens as, I think, the world moves away from the more globalization and more to the as we have over the past, really the past decade, more towards individual focus economic growth and not collective globalization based growth, which is stronger for the entirety of the world. But you can keep tabs on this, and I think you're absolutely right. You're seeing it at the margins, but you're seeing it progress over time. And if we look at a very long time frame, yeah, we are starting to move. And this is for those watching, a 10-year month, a 10-year Treasury yield monthly chart. So it goes back to the past 3-4 decades, and it tells you that yes, these yields are starting to rise in a material way after the pandemic. And can it continue to rise? Yes, it can. So we should be watching not necessarily just the dollar, which is inherently a relative consideration. So we can, I mean, I've been watching the Euro USD on the daily chart. I've been watching dollar yen and seeing how the dollar has been performing against these major alternatives. You can also look at it in yields, essentially the credit quality and the confidence of trade associated in capital flow around the world. So obviously, there's also a demand for U.S. debt in the United States, but you can look at something like 10-year Treasury yields relative to Eurozone 10-year yields, or European Community 10-year yields. And those will tell you the relative confidence that the world has between the United States and the European Union. You can even take it a step further if we're looking at equities. You mentioned that the Dow and the S&P 500 and the Nasdaq 100 are all pushing record highs. Well, maybe we should look at, let's say, the S&P 500, which I think is one of the more recognizable benchmarks for risk appetite globally, especially through the derivatives that are traded, the Spider ETF or futures, and compare it to a rest of world measure. You can look at an individual country, but I like to look at it at the rest of the world. So if you look at the VEU ETF, for example, that's a rest of world equity ETF, and you can see that the US benchmark is losing traction relative to the rest of the world, but it's a long way to go to reverse the trend that has built up exceptional exposure into the US market. So it's a long, long way to go. But at the margins, if you're looking out on the daily, you can see that progress being made. And you can look at measures like search interest, global search interest for terms like Sell America or alternative to the US dollar or things along those lines. So it's not easy to make a pariah out of the largest economy in the world, where you're still very much heavily invested in the economy. You're dependent upon their consumer to purchase a lot of your goods.
Mhm.
But if the pressure keeps up, you will, I think, trend towards that outcome over the long term. So we'll have to keep track of the progress there, I guess. Well, thank you for tuning in to the Trading Global Macro podcast from StoneX. If you enjoyed today's discussion, make sure to subscribe wherever you get your podcast. I'm John Kicklighter.
And I'm Matt. Join us again next week for more insights into the trends and events shaping the world's financial markets. Thank you.